On this channel, we've talked about should you keep renting or finally buy your first home by comparing the sunk costs. And once you got a mortgage, should you prioritize paying it off as fast as possible or invest along the way? We've also discussed the whole debt recycling strategy, try to figure out if it's worth it based on your tax bracket. Now let's fast forward a bit. You've done it, you've paid off your home. Massive congrats, by the way. Now you're looking at your monthly budget and realizing, hey, I got some extra cash flow. So what now? Two popular asset classes normally come to mind, especially for Australians: investment property or shares. So in this video, we're going to run the numbers, real numbers, to back test which asset that you will be better off with a full property cycle 8 years plus. When you buy an investment property, we normally will borrow money from the lender. In other words, you would probably use leverage. So we'll compare two scenarios: investment property versus non-leveraged shares. We'll also use investment property versus leveraged shares by using NAB's equity builder loan. And just so we're clear, we're not borrowing against your home to invest, not diving into complex structures like trusts or self-managed super funds. We're just looking at what it looks like to invest as an individual in a straightforward buy and hold strategy. No house flipping. Let me tell you, the results are very interesting. Before we dive into the case study and start crunching numbers, let's take a step back and look at the bigger picture. What are the pros and cons of investing in property and shares? Let's start with the crowd favorite in Australia, property. There's something about property investing that just feels more real. Maybe it's the fact that you can actually see it, walk through it, and point to it when your parents ask how your investments are going. It's a tangible asset. You can literally drive past it on the weekend. You earn rental income, which can help cover the mortgage early on and eventually become a steady income stream once the loan is paid off. And people always need a place to live, so the chance of a residential property going to zero, pretty much impossible. Rent tends to keep pace with inflation, which makes it a decent hedge over time. And then there are the tax perks: depreciation, negative gearing in Australia, stuff that can help reduce your taxable income. Plus, you can leverage, borrow money to buy a bigger asset than you could afford. This can supercharge your returns if the market plays along. Of course, leverage cuts both ways. Property values can drop, interest rates can rise, and if you're flipping houses for quick gains, timing becomes everything. But for long-term buy and hold investors, it can be a solid strategy. But property is not all sunshine and auctions. It's expensive to get into and sell as well. It takes Australian household roughly 5.6 years to save for a 20% deposit on a median price home. Same duration will go to an investment property. On top of that, there is a quite long list of costs when you buy and sell the property. There is stamp duty, maybe a buyer's agent's fee, maintenance, council rates, landlord insurance, property management fees, land tax. When you sell, there is mortgage discharge registration fee, marketing and advertising costs, legal and conveyance and fees, as well as the real estate agent commission, typically 2% of the sale price. It's not exactly passive. Even if you use a property manager, you still have to make decisions, chase up repairs, and deal with any tenant dramas. It can be stressful. And speaking of tenants, you might go through vacancy periods where no one is renting the place, which hits your cash flow and hurts your yield. Liquidity is another issue. You can't just sell off a room when you need some quick cash. Selling a property takes time and the market might not be on your side when you need it. Then there's portfolio concentration. Property usually takes a big chunk of your savings. So once you're in, your portfolio might be way too skewed towards one asset class and often in just one location, usually where you live. That's called home bias, and it can leave you vulnerable to local economic swings. And finally, every property is different. Unlike shares, which are priced efficiently across global markets, property is messy. One seller might be in a rush, another property might be overpriced. If you're lucky or savvy, you might snag a deal, but it also means that there's a lot more room for error. Alright, let's talk about shares. Compared to property, investing in the stock market is a lot more liquid and flexible. You can jump in and out with just a few taps on your phone, no lawyers, no inspections, no 60-day settlement drama. There's also a much lower barrier to entry. You don't need hundreds of thousands of dollars to get started. With index ETFs and micro investing, you can literally begin with as little as $50 or less. And because you're not dealing with tenants, there's no maintenance, no insurance, no emergency plumbing at 2 a.m. It's a much more passive approach. Set it, forget it, and just keep dollar cost averaging over time. Historically, the Australian share market has returned an average of 13% per year since 1900, including dividends. Costs are also super low. Index ETFs often have management fees under 0.1%, and brokerage fees basically can be neglected depending on your platform. For example, Stake, one of the brokers that I use, is $3 per trade. If you're investing $2,000 a month, that's only 0.15% per transaction. And it's way easier to diversify with shares. You can spread your investment across global markets, local Australian shares, bonds, rates in just a handful of ETFs. Now for the not so fun stuff about shares. The biggest downside of shares: volatility. Share prices can swing wildly, and when markets crash, it's easy to panic. Some downturns can last years, so you're gonna be mentally prepared for that. Investing in shares also requires a bit of emotional discipline. It's easy to say I'll hold through the dips until you're in one. Being rational in an irrational market is harder than it sounds. And if you're picking individual stocks, you're betting on specific companies, and yes, stock price can go to zero. It's rare with index funds, but definitely a risk if you go all in one company. Lastly, shares feel intangible. You don't see or touch them, you just got a balance in your brokerage app and maybe a few ASX letters in the mail. That lack of physical presence can make it feel less real compared to bricks and mortar. So even though property and shares feel like totally different beasts, when you zoom out and look at the long-term data, they are surprisingly similar. According to CoreLogic, Australian residential property values have increased by about 5.4% per year over the past 30 years, throw in an average rental yield of around 3%, and you're looking at a total return of roughly 8.4% annually before inflation. Now, we mentioned earlier that the Australian share market has returned around 13% per year from 1900 to 2023. That's over 120 years of data. But to make this a fair apple-to-apple comparison, let's look at just the past 30 years as well. Over that same 30-year stretch, the total return from the Australian stock market has averaged around 9.2% per year, again, including dividends. So yeah, slightly higher than property, but not by much. Both asset classes have delivered solid long-term returns, with property around 8.4% and shares around 9.2%. The real differences come down to things like how much effort you take, how volatile they are, and how they fit in your personal lifestyle and risk tolerance. Now, let's dive into the numbers. We're comparing two real-world residential property purchases with share portfolio over time. This case study spans full property cycles, 8 and 13 years, using actual sale prices, suburb, specific rental yields, historical interest rates for investment property, and historical share market returns. Property number 1 is a suburb 11k north from Melbourne CBD, and its median 3-bedroom house is about $1 million at the moment. In 2017, you bought a 3-bedroom house for $782,000, covered upfront costs, which includes stamp duty, land transfer fee, legal fees, building and pass inspection costs, mortgage registration fee, and valuation fee of $46,000, and a 25% down payment, totaling $242,000 in initial capital. A mortgage of $586,000 was taken on a 30-year term with interest slightly above owner-occupier rates. Rental income estimated from the suburbs yield was added to monthly repayments to pay down the loan faster. Rent was also adjusted annually with a 2% inflation bump. Along the way, you receive rent but also paid interest on mortgage, ongoing costs like agent property management fee, maintenance, council rates, landlord insurance, and land tax. By 2025, the property was valued at $995,000 with $228,000 left on the loan. This gives us the equity property 1 has built, net profit, and return on investment ROI, which is 7.94% annualized over 8 years. That's close to the average long-term return of the Australian housing market. Instead of property, you invested the same $242,000, which includes the down payment and the total upfront cost, into the Australian share market in 2017. Monthly, instead of mortgage interest and ownership cost, you dollar cost average that same amount into shares. Assume brokerage cost $6.50 per trade, mid-range based on Portforlios brokerage fee. Market performance is based on actual total return data from 2017 to 2025. In 2025, the portfolio is valued $922,000, which gives us the net profit and annualized ROI 6.92%. That's about 1% lower annually than the property return. But with fewer ongoing responsibilities, both of property 1 and non-leveraged share portfolio 1 underperform their asset class average yearly return. Now, let's move on to property number 2 and non-leveraged share portfolio number 2. Property number 2 is in a leafy inner Melbourne suburb, median 3-bedroom house is about $2.3 million at the moment. It was purchased in 2011 for $800,000. $200,000 was the 25% down payment plus $49,000 in upfront costs. We also used rental income to help repay the mortgage. By September 2023, 4 months before the house was revalued, the loan was fully paid off. By early 2024, the house was revalued at $2.6 million. Total expenses over 13 years are as follows, which give us the equity that property number 2 has built, $2.6 million, net profit $2.2 million, and annualized ROI is 11.82%. Meanwhile, we invested lump sum of $249,000 with monthly dollar cost averaging using the amount that you would have spent on interest and ownership costs. 13 years later, the portfolio balance was $1.5 million, which give us the net profit $823,000. Annualized ROI is 6.26%, also underperformed the average share market return by a big margin. If we look at 2 investment properties, one has underperformed and the other has outperformed. And property number 1's house value has appreciated by 27% over 8 years, which equals to 10.8% annual capital appreciation. The interest and owning expense dragged the final total return down to 7.94%. Property number 2's house value has tripled in value over 13 years, which equals to annual capital appreciation of 9.5%, which is pretty impressive. The net profit return on investment was 11.82%, which means that rental income has produced 2.32% in return per year. And surprisingly, the mortgage was paid off within 13 years with the help of the injection of rental income, which proves that location of the property does matter. A property in a nice suburb with great facilities tend to appreciate its value faster, and each property is unique. The timing of entry to buy the property is also critical. If you're lucky, you can buy a property in a much undervalued price. It's like you are winning from the start. And let's not forget about the interest rates. In this experiment, I used the actual real-world interest rates. If it's high, it's going to add the cost to build equity. Property number 2 was in a high-demand suburb with good reputation. That helped accelerate capital growth. Let's look at the 2 non-leveraged share portfolios, why they both underperform by 2% annually. Market timing. We all know stock market tend to provide a pleasant return over 20 plus or longer period. In both of the cases, which were 8 years and 13 years, as I only had the property valuation records for those periods, it's kind of unfair for the share portfolios like timing the market. If it ends up with the bad years, bad luck. Leverage. Both of the properties has a financial leverage of 4x as the accelerator, which means that the gain or loss is amplified by 4 times. In this case, is gains. Without borrowing, the share portfolios rely entirely on organic growth and your contributions. Could leveraging help boost the share portfolio's returns or not? Let's move on to the second set of comparison. Investment property versus leverage share using NAV Equity Builder. The performance metrics remain the same with property number 1. I used NAV's Equity Builder to borrow $20,000 for my share portfolio with a 10-year long term. The additional $20,000 helped the portfolio grow faster from the beginning. The investor also had to pay the interest from the 7.75% interest. After 8 years, the final portfolio balance was $957,000 with net profit $409,000, which gives us the annual ROI of 7.23%. That's 0.3% better than the non-leveraged version, but still lower than property. Despite the lower leverage of 1.08 versus the property's 4x, the leveraged share portfolio and additional interest the investor had to pay, the annual return increased by 0.3% per year. For leveraged shares portfolio number 2, the final portfolio balance has turned into $1.5 million from the initial capital of $269,000. By 2021, the $20,000 investment loan from NAB has paid off. Leveraged share portfolio number 2 has produced $872,000 in net profit or 6.47% annual return, which is 0.2% more annually compared to the non-leveraged share portfolio number 2. Here are a couple trends that I like to draw from this experiment. As leverage amplifies the gains and losses, an investment with borrowed funds tend to have a higher return than the ones don't, as long as the return is positive. We can see the proof by comparing the share portfolios when people use leverage responsibly. Share portfolios all have failed to deliver an average long-term return of 9.2%. The reason for that is that we're not holding the portfolio long enough, and the time frame we picked was random based on the valuation prices that I could get. Property performance varied significantly for the 2 investment portfolios. One has underperformed, the other is outperformed. The potential of the capital appreciation takes the big chunk of the total return. So overall, the location and how much discount your purchase price than the intrinsic house value really determine if you could get a head start or not. So location and entry price could really make a big difference. Finally, investment property versus shares, which asset class make more profit? In this case, property has no doubt from a money perspective. So property or shares, there's no one size fits all answer. Think about your lifestyle, risk appetite, how active or passive you want the investment to be, and how long you're willing to hold the investment. If you save enough, you could even diversify and invest in both.